I think we're live.
Okay, cool. Well then.
We're good.
Mike, thanks for hosting this.
I mean, who's hosting it? Is it me or you? Because technically, you're the one who has the gravitas. So
I don't know about that. You're Mr. Raps.
I, you're Miss Safety. Is it Miss or Mrs. Safety? I don't know. You tell me.
Yeah.
Okay, got it.
Yeah.
Well,
I
thanks so
don't
much
like the
for.
differentiator that men don't have to differentiate. You get to be Mr. regardless, but yeah.
My wife complains all the time about how no one calls her doctor. We'll get invitations to weddings, and she's like, "No one calls me doctor. It's always Mr. and Mrs. Jackson."
Yeah, I'd rather just be just Mr. and Mr.
Let's just keep it super simple.
Yeah.
Well,
Awesome.
thanks so much for joining me. I appreciate it. Thanks so much for coming on here.
Yeah.
So, one reason I reached out to you is, first of all, your reputation is fantastic in the whole safety world of how you get transactions done. In fact, would you mind giving us the quick elevator pitch as to what exactly your business is and how you work?
Yeah. So I help private lenders conduct due diligence so that they can lend safely. And then I've kind of extended that beyond and out to, I help investors do due diligence because when it comes to these creative transactions, there's a lot more than just an appraisal and a property inspection when we've got all of this flexibility.
And, that's exactly why I reached out to you, because I have this inner fear of our subject to world, which is a world where we met, of maybe being disrupted a little bit potentially, is if things go the way that I fear they're going. And so I reached out to you, and I basically just said, look, Mel, my concern here is that I'm seeing a lot of these transactions being done incorrectly, unethically, immorally, and I want to be able to buy subject to transactions for the remainder of my life. And I don't ever want it to be outlawed, prohibited, restricted in any way. And since you're the person who is really the person to go to when it comes to doing things ethically and making sure the transactions are done in a way where everyone wins, right? So having said that, thank you again so much for joining me. I do appreciate that. I wanted to run a couple of things by you.
Yeah.
With regard to subject to transactions and maybe how we can start to do them a little bit more safely. I have some ideas, but I'm kind of curious as to what you're seeing out there as well. Are you seeing a lot of subject to transactions either default, or are you seeing subject to transactions, even from a lender's standpoint, maybe not done in the way that you would prefer to have it done?
Yeah. So I'll say yes for both, but I'll back up. And when it comes to like subject to transactions defaulting, I think there's two types, right? There's one where it's like the naked sub to, where it's just the seller to the buyer. Even if that buyer, it has a wholesaler in between, it's a naked sub to. You've just got the underlying mortgage.
Can you clarify that a little bit? Because I think that, I know what you're talking about.
Yeah.
But when you say naked, what exactly do you mean?
Yeah. So, I mean, Mike Jackson's got a, 3.5% loan with a remaining balance of $485,000. And you're going to give me either a login or your login, and I'm just going to pay your mortgage directly, right? There's also where you can wrap it, right? Where it's going to be that exact same mortgage, but we're going to put another note around it. I love Gary
Shevitz, yeah.
Shevitz had said, called it a turducken situation. And I love that. And so you got your turkey and you can put a duck in it, right? You can also do a chicken. So it can just be the turkey and the duck. That's a wrap. Or it can be the turkey, the duck, and a chicken. And that is where you've got a carry back note. So say that you had that I don't know what I said, $435,000 is what's remaining, but say your mortgage is worth, or your property is worth $535,000. So we want to make sure you're getting a carry back note, and we're only having one payment. We've got one mortgage, one note. And so you just kind of wrap those other two notes inside of the other one, if you will. And I just like that visualization that he gave. So hopefully that helps.
It's making me hungry.
Yeah.
So thanks so much for doing that. I appreciate that.
Yeah.
As far as the naked transaction goes, the naked sub two, I think that's exactly what I'm referring to. This is my biggest concern right now in the market, is that people who aren't trained properly or have the proper connections with closing attorneys or transaction coordinators are basically just taking over payments. Now, a lot of people think that's what a subject to transaction is. And for the most part, that is what it is.
Yeah, it can be.
But
it's kind of sloppy.
no, right. And so, let's dive into that a little bit, because I think that that's super, super important. So let's say that it's a straight sub two, there's no seller finance piece to it. And basically what I'm doing is I'm buying your house sub two. And so how would you ideally want, from a seller standpoint, to structure that so that you're best protected?
Yeah. I mean, from a seller's standpoint, one, I'd back up. You actually mentioned, hey, people just buying stuff without a transaction coordinator, without a closing attorney, right? First and foremost, that's how you can help mitigate your risks. It doesn't eliminate them, and it doesn't mean that you're safe, but involving third parties, professional services is one way to mitigate risks. Second, as somebody, I would personally, I would probably do sort of contract for sale. I wouldn't do a sub two.
Yeah. Why would you do that?
I considering it's my credit on the line, and I have no proof of performance from this person typically. Now, you could go down that rabbit hole, and that's part of what I do as a due diligence consultant, is helping people verify claims. But a lot of people that are buying creative transactions don't necessarily, they're doing this for the ease of the transaction. So you want an easy transaction, no problem, but I'm not transferring the deed. Is how I would treat that.
Sure. So in a contract for deed, a land contract, however, wherever you are in the country, it's called different things.
Yeah.
How are you as the seller? How does that make you feel? Why does that make you feel more comfortable if someone has taken over your mortgage, structuring it that way?
Well, that way, if they do default, I'm not having to go through a foreclosure process or attempt to go through a foreclosure process, because the reality as well is that I won't be able to go through a foreclosure process because I've already transferred the deed and I'm not the note holder, the bank is. So you can either wrap it and become the note holder, or you just keep that note. Like, that's mine. I'm not transferring it. I don't owe you, the convenience and benefits of homeownership if you're not going to go through the process. And, and I would say there's varying levels of motivation that would change that tune, right? So if somebody's underwater and they really want to get out of this property, and that's the only way if there's leverage and that's the sticking point and they can't find anyone else to buy this property, maybe. But, the desperate scenario is a yucky place to be. And then if we go back to what we talked about in the beginning about structuring win-wins, it's not a good place to be when you're structuring a win-lose or even a win-neutral, because this is a long-term relationship and essentially a marriage. When you're talking about a lot of people that are underwater on their mortgages are underwater because they're selling after very recently buying. And so this is almost a 30-year relationship, longer than most marriages. And so to enter this on a win-lose or on a win-neutral is like, that's a shitty way to treat your long-term partner here. So
I 100% agree. And I'll also add another point to that too, is that if you're selling in a desperate situation, something in your life has happened that impacts it tremendously, right? If you have to sell your home for some reason and you're going to lose cash by selling at retail, that's not your first choice, right? Either you're being forced out of your house for whatever reason, or you've lost a job and you can't afford your payments. And so by even going in there as a buyer and giving them a quote unquote solution, but it takes advantage of the seller, that's not a good way to start a relationship either.
Totally. Yeah. And so I think, a lot of people get into this saying that they want to help people. I think you really, really need to go back to that core value and whether or not that's true. And if it is true, making sure that you're actually helping people, right? Not just taking the best deal you can get, because sometimes it's nasty.
I think that's a great point, because I think that there's a group of people who choose to do these types of transactions because it does provide the seller with another option, right? It provides them with something that maybe makes more sense than selling it through a real estate agent or a for sale by owner. And so I think that, for someone who chooses to go that route, protecting them in the best way that we possibly can as buyers, especially given the fact that, like you said, it is an incredibly long-term relationship, this has to start off on the right foot, right? It can't be this bait and switch. It can't be an assignment to someone who the seller does not know or trust.
Right.
It can't be all of these things that can happen and we see happen a lot. And so there's a group of people out there who truly want to do things the right way. And then there's a group of people, which unfortunately I think is probably a little bit larger, where all they want to do is make that assignment fee, right? Or make a little bit of money on a wrap transaction or cash flow or whatever it is. They hope that the seller doesn't find out about something that they've done during the transaction process. But when it does happen, I've never seen it end well.
No, never. Never. And people love to think that they're going to take a seller to court because they're in a contract with them. And again, if we go back to like, you're going to force someone to marry you, like this requires their cooperation. And I try to take that to judge. And then let's go back to the whole premise of our talk is, are people going to crack down on this? Because if enough judges were to see those kinds of cases where you're forcing a seller into a predatory circumstance, I don't see that going well for anybody.
It just takes one.
Yeah.
It takes one bad situation and one loud seller who might be an attorney or who knows a friend who is a real estate attorney to shut this down. And I don't expect it to happen. It's a really hard thing to shut down seller finance transactions, which have been around for hundreds of years. But we're seeing all these wholesale laws now come out, right?
Right.
Where they're starting to shut down and restrict transactions. And it wouldn't surprise me if they shut down subject to transactions or tried to.
And you see other things happen too. Like I've got a friend who had a cash contract. And she had nurtured this lead for months. Every single call was recorded, and was basically, it was like a last, ditch for the guy. And because she had it under contract, she didn't mind doing an open house. In the open house, somebody was able to convince him to not do the deal with her, try to break his contract and get, something like $1,000 more from him. So the wholesaler went around the wholesaler and tried to buy direct. And so again, she's got everything recorded. She's got all of her disclosures. She's got all of the paperwork. And at the end of the day, she got like an elder abuse, like based on his age, based on their state, based on a couple things. And it was just like completely wrong. Mm-hmm. There was no part of it held any water, but he had a good attorney, and her attorney couldn't combat that claim because the elements of the crime were super simple. It was based on the age, and it was based on his feeling of being abused. And it's like, oh wow, the threshold, the elements of the crime and the threshold are really low when it comes to that. And there's a reason for the law, and we're happy it exists to protect people, but some people use the law. Just because something's legal or illegal doesn't mean it's right or wrong. And that's like a perfect example of the law in action.
I agree 100%. It's sort of like these people who get a property under contract and then immediately put a memorandum on the property, right? And never really intend to buy it. And
right.
The law really should, I think it states that if you do file a memorandum, you're filing a memorandum because you're planning to purchase the property with the underlying agreement that was agreed upon by both parties.
Right.
And there's some people who just frivolously put memorandums on properties. And it's just that kind of business is not the kind of business that's going to allow the rest of us to do it well, or at least stay in good standing with agents and sellers and attorneys locally.
Right. And I mean, like the state of California, because of that basically just clogging up the judicial system, said, nope, you cannot. Lis pendens is the only way you can do it. And there's got to be some sort of, legal. There's way more thresholds to be able to file a lis pendens versus the memorandum, and that's because of the abuse of the memorandum. So
Right.
you see these little incremental changes that occur when people abuse the system. And so it's like you either self-regulate or you'll get regulated.
Yeah. And whether it's the industry that regulates you or the law that regulates you. Right. And, so going back to the idea of how to structure the transaction itself. So it sounds to me like you're a fan of a contract for deed, a land contract, something along those lines that keeps you actually in the driver's seat, that will allow you to foreclose in the event that you have to.
Right. Or wrap. Yeah. So,
wrap.
yeah.
Yeah. And that's the way that I do all of my transactions, is what we'll do. And just to kind of clarify exactly what it is. A lot of people think that a wrap has to be at a higher interest rate or more principal, but you can basically just take the underlying mortgage and mirror those terms, right? It's called a mirror wrap.
Yeah.
And so how does a mirror wrap protect the seller in that case? So let's say, for example, that I buy your property and we wrap it. So you're now holding a note that mirrors the underlying note that you have with your Wells Fargo bank or Bank of America.
You just hit it. It's that I'm the note holder. It's no longer Wells Fargo.
Mm-hmm.
Right. And so that's what gives me some control instead of me now being a third party between you and my loan. It's now I'm I'm in between the loan and you. And that's where it helps sellers. And from a seller standpoint is like, from a buyer standpoint, if you want to protect your sellers, that's how you do it. Not these frivolous, hold no water deed in lieu of foreclosure, because again, I'm not going to deed the property back to you in lieu of you going into foreclosure, because that doesn't affect me.
Right.
So like, why would I do that? And that paper itself cannot, a lot of people will try to get it signed and notarized before closing, and you only record it if somebody is to default, but that is completely that's not legal. Like, you can't have something predated or blank dated and have it be a legitimate notarized document. I imagine that would get a notary in trouble. If
you're signing a document that basically states, in the event of this happening, it's pre-signed. You can't say that, okay, look, you pre-signed that this might happen and such, I'm now going to take the property back. So we talk a lot about deeds in lieu of foreclosure, performance deeds.
Yeah, performance deeds. Yeah.
It's kind of the same. It's basically the same idea, right? It's basically saying that, look, if this happens, then this happens.
Right. But we still need to enforce it if you don't actually agree to do it when it's time.
Exactly. And, to the point of wrapping a sub 2, what we basically do as investors, if we're providing the seller with that note, promissory note, and a deed of trust, we determine what those terms are for that note, right? And so the principal balance is generally the same. The interest rate's generally the same. The payoff date is generally the same. But one thing that we can change is the term default, right? Yeah. We can change what that means. And so, what I typically do, and I'm curious what you would do, what I'll do is I'll generally have my term of default as 30 days or 60 days after the first missed payment. And then at that point, the lender, in this case, the seller, can initiate the foreclosure process if they choose to do so. Do you do something kind of similar?
Yeah. So I'm trying to remember, I think the way a consumer loan, like a Wells Fargo loan, is typically worded is something like 15 days. It doesn't count as late until it's 15 days late.
Whatever the grace period is.
Yeah. So I always like to make it 5 days, not 15.
Mhm.
This is not a consumer loan. This is an investor loan. And we're going to establish that via paperwork 10 different ways throughout the transaction.
Yep.
I'm not giving you consumer protection because you're
No.
not a consumer, you're an investor.
Mhm.
So, one, change that to 5 days, and two, I 15 or 30, whatever. But just making sure that we are establishing that this is not a consumer loan and consumer protection laws do not apply is very important.
And that's a huge difference, right? Because a Wells Fargo loan or a consumer loan of some sort is generally going to have a default terminology, or they can start the foreclosure process after 120 days or
Right. Something
150
super
days.
general, depending
Yeah,
on the.
exactly. And, even in a state like Texas, which, they're going to take you out back and the sheriff's going to take care of you. If you don't pay your Bank of America loan, they take a long time to foreclose on you with a typical consumer type of loan. And so as investors, what we can do is structure our loans differently. And in this case, it's really good for the seller. It's also good for the investor too, right? Because we are dictating the terms together with the seller. And
Right.
so in that sense, we're protecting them. So, another thing that I always like to do as well when it comes to creating the promissory note and the deed of trust is set up a servicing account for the loan. Do you do the same thing?
Definitely recommend it. I haven't seen a lot of people do it because when I was doing transaction consulting, I wouldn't do it for them. I just pass them off.
Mhm.
Do you have success? Do you have like a company you like to work with?
I do. There's a couple here. So in Texas, I use August REI. I've used Provident. I've used Westar. I think that you really just have to find someone who is going to make sure that they notify all parties of payment or mispayment, more importantly, right?
Yeah.
And so, that's the idea with the servicing is make sure that some third party handles the money so that the underlying loan is paid for with the Bank of America or Wells Fargo. And so there's a pass through, right? So technically, if I'm buying your house, Mel, and you hold the note, what I'm doing is I'm paying you first, right? And then I guess you are technically paying the bank. And there's proof of those payments. And so the reason that we do that is just so on a monthly basis, the seller who has that promissory note and deed of trust is notified of payments. So there's no, everyone's aware of where the loan is at.
Yeah.
So
critical.
Yeah, no, I 100% agree with that. What do you think about, have you heard of this new phenomenon, putting properties into trusts before you buy it sub to?
Yeah. So I had a couple of clients that did that in Florida. And I know it's a strategy that's been employed for some 40, 50 years. It is, something that people do. And I recently heard Sean St. Clair talking about some of the limiting factors and people liability requirements that need to be considered in addition to the trusts. But it's not something I've personally seen often. I just have one client that did it in Florida specifically.
Was that a trust, like a living trust, or was that some sort of a land contract or land trust or something like that? Florida's
I'm
probably a land trust.
Yeah, I think it was a land trust. I remember he had it set up from like nevadalandtrust.com. Something
Makes
super
sense, yeah.
official, but I'll say those attorneys were like on point for all their document reviews. And I think we had like some 100-page document that we had to review after they prepared them. So they were definitely thorough, but it was nevadalandtrust.com.
So, one thing that we run into a lot are sellers who are concerned about a couple of things, right? Default is one of them. And we've talked a little bit about how we can protect a seller in that case, right? You can either do a land contract, a contract for deed. You can put it into, you could build a wrap around it, right? So that the seller holds that note in the deed of trust. And then the other thing that they're generally concerned about as well is what happens if the note gets called due, right? And there are a couple of reasons that this does happen sometimes. Sometimes it happens at smaller banks, if it's a local bank or some bankers flipping through actual paper, and noticing that there's a conveyance on the property. Or it happens because insurance is are improperly completed
Right.
or added. In fact, I'm seeing a lot more due on sales being called. Are you seeing something similar as well?
I've seen them recently. I don't know that it's more, I'd say it's more in number, but I would say like ratio might not be more because I think when I joined the mentorship, it was something like 3,200 people. And there's like, I don't know, 13,000 people now. So I have seen them um in larger numbers, but I don't know that we don't necessarily have a good grasp of the data for like how many transactions are happening on a monthly basis, unfortunately. But yeah, I have seen them lately, but I feel like, and I might be wrong, but I feel like it's just because there's so many more people that are doing these transactions now.
I don't think you're wrong at all. I think that there are probably 100 times more people doing subject to transactions, right, than there were 3 or 4 years ago.
Right.
There's one company, I forget what the company is, something loan servicing, that I've seen call more notes due,
Oh,
which is really interesting, actually. And I don't know why, but I kind of heard it in the rumor mill. And then I heard an attorney say the same thing, that a couple of their notes got called due. Now, one of the ways that they protected themselves after the note got called due, and they are encouraging their clients, this is an attorney, mind you, so seek legal advice that you don't get here, is they're putting the property into a living trust, a revocable living trust, and they're naming the buyer as the co-beneficiary. And so the reason that they're doing that is to protect against the due on sale clause being called as a result of the property being protected by the Garn-St. Germain Act of 1982.
mm,
And so what that basically states, and by the way, there's no foolproof way of the property's note being called due, right? The note could still be called due, but this act might help protect against the property ultimately. What was that? Did you hear that?
like the glitch.
Yeah, what was,
Yeah.
I don't know if that was a comment or what. I was like, oh, someone's watching. So what I was saying is that it's not going to protect against the note being called due necessarily, but it could protect against the bank forcing that sale of the property or refinance of the note or whatever that is with the note. But basically all that it states is if a property is in a trust, then a lender cannot call that note due or take that note back.
Interesting.
Now, there are a few different loopholes to it, if you will, from a lender's perspective, but it's an extra layer, at least, that it could help possibly protect the seller from that situation happening. And so what we do is we do put the property into a living trust. The other thing that we do too is we make sure that the insurance is done correctly,
Yeah.
right, by someone who is familiar with subject to insurance, because it does differ from a typical type of transaction. You have to have the seller on there. You have to do all those sorts of things. But what we want to make sure of is that at least if we're in a position of the note being called due, that everybody knows what exactly is going to happen at that point. Right. And so that goes into communication, which you're really big on with your investors.
Right.
So, from an investor standpoint, and I guess a seller or let's say a lender standpoint, what type of communication do you think is really, really important to just maintain? Is it certain things, or is it everything, or somewhere in between?
So I think in the beginning, it's everything. The disclosures themselves are insufficient because it's boring, it's long, it's a little bit legalese. And so I think it's really important to have very open, honest communication. I would do seller walkthroughs with sellers often where we would go over each and every disclosure and allow them questions, because what they'll do is they'll sit there. There's like one of two ways this goes. One, they just DocuSign and click, 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 click. It's like, oh man.
It's like the terms and conditions. Have you ever read the terms and conditions?
So my
Never.
husband makes fun of me because I'm like the kind of weirdo that does.
Well, you're the one person. Someone has to do it. So
Someone has to do it. Yeah. And then I'll hold their hand and walk them through the terms and conditions too. And so, so I do think that's really, really critical is the seller disclosures in the beginning while you're having these conversations, and talking through scenarios and how we, are expected to work together if the worst case scenario does occur. And I think you hit the nail on the head with like, they are not called frequently, but when they are, usually one, small bank, two, insurance lapse, or three, some other sort of paperwork errors. So missed payments being one of them. So those are the three ways that we see it getting called due typically that will raise flags. Or two rather, and then the one being it's small and they notice everything. So yeah, I think, making sure that everybody understands what's happening at the beginning is important. But then, monthly communication can be outsourced by a servicing company. So monthly communication is important too. And, my specialty with due diligence is primarily helping private lenders, and so many people are happy to, count it as mailbox money and just agree to balloon terms because sometimes they don't, think about the fact that there's no indicator for how things are going when you have a balloon,
right.
especially, so you have no idea how things are going if there's no communication. Whereas at least if you have a monthly payment, that's a little indicator that things are all right. Because if that payment gets missed, now that's an indicator that they're not all right. But I do think, monthly communication is important, especially if you've got some sort of project that's tied to the property. But if we're going back to just, a regular sub 2 or even a hybrid type sub 2, just the communication is important beyond closing. And I would say that's just in the form of making sure payments are made and that there's proof. You shouldn't have to ask for it.
No, it really just takes an email or a text on a monthly basis. Hey, just made the payment. Hey, servicing just sent me this. Here's a forwarded email from servicing. One thing that occurred to me when you were speaking was the idea of kind of blinding sellers during the sales process of the subject to transaction. Before close, they never bring up some things, right? They don't want to talk about what happens. What's a worst case scenario, right? They're afraid. It's sort of like it's when an investor's afraid to tell the agent or to tell the seller that they've assigned the contract on a cash transaction.
Yeah.
That's small peanuts compared to this, right? And, one thing that I think investors fail to do a lot of the time is to communicate the bad things that could happen as a result of going through this transaction.
Yeah.
Because it is different. And, a due on sale clause, it's not the end of the world. There's remedies for it and ways that you can protect yourself. But the worst case to me is if a seller is unaware of that potential and then it happening and then the investor not knowing what to do with it. Right.
Because that due on sale is going to require a lot of cooperation from that original seller. So if they're blindsided by it, this is also bringing up an old wound, which is this fucking house they couldn't sell, right? Oh, and now it's back to haunt me. So you just have to be very transparent in the beginning, because it's so much easier to tell someone up front, no matter how hard it is, it's easier to do it up front than try to chase. And, there's a lot of, especially in this community of fast to take action without, knowledge or practice or professional services involved. There's a lot of, ask for forgiveness, not for permission, right? But I think in this case, maybe that applies to your W-2 work office or something. But like when you're talking entire mortgages and lives and huge investments, it's not.
You said it. This is a life, right? People work their butts off at their W-2 so they can afford a house for their family.
Yeah.
Right. It's their biggest asset. Most people's biggest asset.
Yep.
And what we're doing is we're taking responsibility for it. And so to do that unethically or immorally is the wrong thing to do.
Yeah.
And is it worth $10,000, for example, to just to lie to somebody in hopes that something bad doesn't happen?
Yeah. I had to quick look up. Mortgage is a death pledge, right? This is like a lifetime contract back when the, average lifespan was like 50 years old. So it is a
Yeah,
life.
it
Like the
100%
term.
is. And here's the thing too, is that the mortgages that we're taking over sub two, we're taking over mortgages that are 4.5% or less interest, right? That's the advantage for investors like us, is where we can take that over. That's the asset, right? For us, that's the advantage.
That's the
And so,
privilege and the responsibility that comes with it, with
yep,
that privilege.
exactly. And, to that point, I don't think that we're ever going to see interest rates come back to that point. I mean, if something bad happens in the economy or the world, maybe we will. They're going to come down a little bit, but are they going to come back down to 3% ever again? Who knows, right? And so the idea of ever refinancing that out just for the sake of refinancing that out is probably not going to happen a whole lot of the time. The house might sell, or something happens along the way and you have to do a refinance, you're getting cash out or whatever. But at 3% rates, there's not a whole lot of incentive to go out and get a 6% mortgage. And so, those mortgages are going to stay in place a whole lot longer than they would if they were 6.5 or 7.5%.
There's some golden handcuffs.
Golden handcuffs. And to your point earlier, it's a marriage, right? It's a long-term relationship. So, I think that, so we've covered so far servicing, how we can structure the purchase so that the seller is protected. We've gone over how you can possibly foreclose if that is the case. And that's really important too, right? Because you need a remedy in the case of something going wrong with the buyer.
Right.
What else can you do? So we got servicing, we got happens in the case of default. We've addressed due on sale clauses. Can you think of anything else from maybe a lender's perspective that you would want to do if one of your lenders is coming in to best protect them?
Well, when it comes to lending, there's a whole other element of like underwriting that you want to make sure that you're doing. And so when you're underwriting, you're not only looking at cash flow to make sure that people can pay, because that mortgage itself, and underwriting could be important for a seller too, to make sure, hey, if this property, I can't rent this out. Maybe one of my options was I kept this property and rented it out, but I know I can't even pay my mortgage with the rental income. So when you look at underwriting, you're looking at what kind of cash flow the property can have and whether or not it sustains itself. And so if my mortgage payment is $1,000 and monthly rent income would only be $1,000, but then I also have taxes and insurance and vacancy and maintenance, I know I'm probably going to take a hit monthly. And often they're worse than that. Often it's like, the rent is $200 lower than what the mortgage is. So now if we've got a second loan in place, say you're a lender and you're going to help make up that difference of equity in this wrap hybrid sub 2 that we have. Now I really want to make sure I'm checking out whether or not the individual has personal finances that are capable of absorbing that, $300 monthly loss. The $600 that they're going to have to pay when a water heater goes out, some sort of reserves or war chest, lots of considerations with underwriting specifically, because when it comes to comping, we already know that this property is underwater, most likely, or at least 100% leveraged, because these sellers want all of their equity out of it when they are selling this property in a creative manner. And so from a lender's perspective, you really need to be cognizant of whether or not people can pay what they're agreeing to. And
how do you check that, Mel? What do you check to verify?
A lot. So we'll ask, like, okay, so one thing is maybe they have a creative exit strategy and a long-term rental is only going to get them something, but oh, I'm going to do an Airbnb and this is a hot Airbnb market. Cool. What's your experience with Airbnb? Because there's a learning curve.
Mhm.
I have one. It's trash. I mean, it's fine. It's a super cute place, but the learning curve is trash. The learning curve, there's a lot of vacancy. There's a lot of Airbnb, shenanigans. If you decide to outsource and get yourself a host, awesome. Well, guess what? Now you have to do due diligence on hosts because a lot of them suck. And a lot of them have even more vacancy than even a brand new DIY Airbnb host would have.
And you have to underwrite as the host is being involved.
Correct.
Yeah.
So, so if you want to, the answer to that question depends on the exit strategy. So then we would look at the person's background, education, and experience. That's the simple answer, right? And then the more complicated answer is it depends on all of those things too, right? And so we look at background, education, experience, assets, income, and credit. And people don't like that one.
They don't like credit?
Yeah, because they think, if it's sub 2, I don't have the banks involved, so why should I have to have credit involved? And but if I'm expecting you to make a mortgage payment and perhaps a private loan in addition to that mortgage payment, I want to make sure you're paying Visa, because if you're not paying Visa, you're not going to pay me.
Nope.
There's patterns of behavior, and I'd like to identify them before I get into marriage with them.
So you're talking about a couple of different things here. First, right? You're talking about not only do you underwrite the property, you underwrite the buyer, and what their exit strategy is given the underwriting on the property, right? Yeah. So, for example, if I'm coming to you and I'm like you said, for a long-term rental example, if I'm coming wanting to buy this property, but I have to borrow 50 grand to buy it, and my rent is already below whatever my PITI is on the property, that's going to be a tough sell, right? What's the advantage for me as the buyer? Am I getting tax benefits? I'm not getting cash flow, at least as a long-term rental. And so you're actually taking into account what the exit is to make sure that it makes sense. I think a lot of things can be solved just by logic. And does this make sense? And so it sounds like that's exactly what you're looking at, but deeper into that logic.
And everybody's logic is different, right? Like some people are just trying to get assets, and this is a way they can do it. And they're just acknowledging, I'm going to take a monthly hit, but I have this belief system that is so painfully tied to holding, assets, right? And a lot of people are like that. And I think that's a very American ideal. And people are accepting, I think, right now that real estate is more and more and more unaffordable. So they're just kind of willing to take a big, nasty, shit sandwich.
Right.
So I think one, just acknowledging it, logic is different to everybody, but I still need to know that you can make the payment, even if you're willing to agree to it. There's still, and so I always tell people, you're looking at the deal, the person, and the verified information, because that's where it's like, great, you said you're going to pay. You said you're okay with this trash deal. You said you want this property, but how do we, and you can't predict, we're not fortune tellers, right? But there are, one, patterns of behavior, and that's why I think credit's important. And two, ways to verify. Verification will be, I'm talking about, hey, you need to have some sort of reserve in place so that you can afford the maintenance fees that inevitably occur with a new property, even in a new property, but a new to you property, perhaps a new to you venture. If you've never owned real estate before, buckle up, because Murphy's Law is coming.
And there are costs associated with it, right? I mean, even long-term rentals, there's lease-up costs. There are management costs. There are things that you're going to have to pay that I think that as a new landlord, for example, you don't think about until you actually do it.
Yeah.
And so, for someone like you to come in and say, look, this is what you're going to encounter, just to properly set expectations, I think is really, really important.
Yeah. And, at the end of the day, people can still buy deals, right? You can still do it, but it's just making sure that there's communication, because there's so many assumptions in play. And, again, untangling the yarn ball, that, the messes that occur later is so much harder when emotions are elevated, money's involved, credit might be taking a hit, and there's a lot more at stake when you're in crisis versus having the tough conversations up front.
Right. What are some red flags that you've run into, or if we're thinking about borrowers, right? What are some things that we want to keep an eye out for from a lender's perspective when we're trying to determine whether it's a deal that we want to lend on or not? I know we've discussed a lot of them, but just to kind of bullet point it a little bit.
Knowing absolutely nothing. If it's somebody's first deal, it's almost always a bad, like, it's almost always a rough, if they've never even bought a primary property, use a traditional loan, brand new investor, big red flag right away.
Yep.
And, part of me hates to say that because I want people to get excited and get started. But at the same time, if they're not leveraging other people with more experience, they are subjecting everybody else to the collateral damage of their lessons. So new investor, almost always a red flag.
What can a new investor do to increase their likelihood of being funded, or at least do the transaction that's successful?
Yeah, so I always think, gaining skills is the hard, time-consuming task that everybody should do, right? Should. Now, a lot of people want cheat codes. Cheat code is partnering with people who are experienced, but there's problems there too. Because some people, again, when it's back to verifying, people can present as very experienced and not be experienced. And so then you're getting into a different kind of marriage with people who might be doing shady deals, and you might not know any better because you're new. And so then it goes right back to that skill acquisition. I think people really need to take time and develop skills. Identify one. You don't have to be good at everything, but identify one. If you want to be good at underwriting, if you want to be good at deal structuring, if you want to be, and some of these skills will end up being interdisciplinary. You'll start to gain other skills as you build one, as you network with people, as you see and touch more deals. And so, unfortunately, everybody wants a cheat code, but cheat codes have their limitations as well. And so, it's certainly joining teams. A lot of people are doing this so that they can leave their W-2 and then they find themselves kind of working for somebody else again. But it goes back to that, like, learning from people who are doing what you want to do. So if they've already built a team, if they've already got deals and lead acquisition and an entire, pipeline, that might be where you want to be. And, maybe you didn't expect to leave your W-2 to go work for someone else, but it's in the field that you want to be in. It's on the road you want to be driving on. And so just taking it one step at a time instead of trying to just go in and buy your first deal. So I would say, yeah.
And I think that happens
almost always a big red flag. Hey, sweetie.
And I think that happens a lot, right? Because I think that anytime someone spends a lot of money on a mentorship, for example, right, they think that they're buying a cheat code or a get rich quick model.
Right.
And, sub two specifically.
You're still cheating more than you would if you didn't have that.
100%. Basically, what you're doing is you're becoming part of a very large group of, you're becoming a part of a very large mastermind, right? Hey, let's put all these ideas together and we'll tell you what's working, what's not working. But I think a lot of people jump right in without the experience and go, I'm going to go buy a dozen properties in my first year. Yeah. Well, do you own your own home? No, I don't own my own home, but I'm going to go use other people's money to do this. And I think you really have to see the process from start to finish in terms of, first of all, how do I acquire a property? What's the management like, right? Because we see a lot of people get into Airbnb or midterm rental or something along those lines, and they don't know what they're doing and they lose their butts. Yeah. And so even just the idea of buying some sort of a long-term rental with somebody, you don't have to eat the whole pie yourself the first time, right? We have some time to do this and to build up our assets. And you don't have to go buy 24 properties in the first year.
Get a bellyache.
Yeah, let's take our time, and I think joining a team is a really good example because without the experience, you're not going to be good at everything right off the bat anyway.
No.
So
And
build
it's
those
hard to
skills.
get this, like, the reps in when you're doing it by yourself. Let's just say you're committed to building skills, right? You're not going to touch as many deals if you're not working on someone else, and then you don't have any supervisory like assistance or somebody to backstop it off. Maybe you do if you've got, friends you've made, but it's a good system and structure and a bit of an accountability tool too for people to just leverage other people's resources, because often they don't have to do all their own subscriptions then. It's really, really hard to get started. And then you find out that the tech stack is going to slam you almost as hard as the mentorship cost.
And there's some very expensive lessons as well,
Yeah.
right? In real estate, it's very easy to make mistakes that cost money.
Yeah.
And, I talk to a lot of people who lose money on transactions, and successful ones say those were very expensive lessons.
Very expensive. Yeah.
But if you're not well capitalized, you won't last more than a couple of those lessons, right? You're out of the game.
Yeah. And some of that capital's up here because some people will
Yep.
quit the second they run into their first hurdle. And it's understandable because it immediately reinforces what everyone says. Real estate's risky. You shouldn't loan money to, to friends and family or whatever. Like online education's all a scam, right? It's going to start reinforcing all these limiting beliefs that you already might hold a little bit the second you fail. So it's not to say avoid failure, because you can't. It's going to happen, but you can backstop it and mitigate it, and kind of fortify yourself to be prepared for them when you make smarter choices. I think.
And I think that's what you've done really, really well, right? Is you've provided that service to people to help better protect them. And so tell me, I'm kind of curious to learn a little bit more about your process with what you do in terms of your due diligence. So who is the perfect client to come to you? For example, is it a lender? Is it a borrower? Who is the perfect person to come to you?
Private lenders. Yeah.
Okay.
So I've got two types of services. One is done with you. We build out your custom lending criteria, your due diligence process, and you get to leverage me and my team to be able to bring deals that we'll vet with you and then put them against your lending criteria that we developed together, based on your goals, your target markets, your target returns, whatever. So that's what I'm really shifting my focus to, because what I was doing, and I'm still doing it, but what I was doing is done for you, deal by deal vetting. And what I found is I can only give the information as found. So I'm going to vet the deal. I'm going to look at the numbers. I'm going to look at, so we're looking at the security, the underwriting, the comping, the exit strategy as presented, a bunch of different factors. I'll say about 8 factors that we look at for the deal. Then we look at the person, and those are the 6 factors I mentioned, where we're looking at background, education, experience, assets, income, and credit. And then for the verification part, that's where I'm actually pulling these background checks. I'm looking at their bank documents. I'm looking at a CMA if they've got a comparative market analysis for their comps. I'm looking at the figures and the numbers, not just what somebody told me and filled out on a form, right? So that's the verification element. And then what I would do is I would present a report to people. Well, with this report, people want me to tell them what to do. And I'm like, I cannot tell you what to do. This is not my deal. I do not know your risk tolerance. I do not know your lending criteria, your buying criteria, all these things that I now do for my informed investors, where I'm like, let's establish this first, and then you can bring deals to me.
Nor do you want to take on that risk of saying, yeah, go ahead. And then if it falls out.
No, absolutely not.
Yeah.
Yeah. So it's like, I told you I'd bet the deal on the person. I did that. I'm not going to tell you how to spend your money, because you can risk it for the biscuit. I'm not, that's your game. So,
How many deals would you say that come across your desk from lenders that wanted you to take a look at it? Would you just throw in the trash? Would you not necessarily do?
So coming across my desk, always 10 times out of 10, I'm like, insufficient information, versus coming through my process, right? Going through my service. A lot of them require further conversations. They require restructuring. I put a lot of recommendations in there where I'm like, if you decide to do this, I would consider restructuring. I would consider this security instrument. I would consider talking to, just kind of reformatting things a little bit. I think everything can be a deal, right?
Yeah, you can make a deal somehow.
You can make a lot of things a deal as long as you have the foundation of that relationship to be able to go back and negotiate and have these conversations. And so, but what I'll say is the whole reason why I kind of structured my my service and then like the one-on-one service, and that's like a long-term 6-month program that I've been doing with a couple of clients, and that is so much more rewarding and fun. And I see them, finding their deals, and I'm helping them on their postmortem file review. And so we can say, oh, maybe next time let's make sure that this actually happens, because they said that they provide you A, B, C, X, Y, Z, but they only put that in the initial email. They didn't put that in the JV agreement, and they didn't actually do it after. No, we asked them to, and they did it. That's fine. That's part of the postmortem file review, right? But it gives you lessons learned so you can kind of lock in your process, because the other part that I didn't love, but it's better than nothing, is with a due diligence service. It was kind of like, hey, here you go. And that's it. That's the end of the service. So I don't know what happens after. I don't know if they fund it. I don't know if they follow through on any of the recommendations that I had. And so it's a little nicer to be able to walk the dog with them.
Well, in that sense, you're really teaching an investor to fish, right?
Totally.
This program is a 6-month program where you're really showing them what you're looking at from a due diligence standpoint. What would I want to see to make sure that this is a viable lending opportunity for myself, so that in month 7 or 12 or 18, they're much better off than they were if they were to do this on their own from month 1.
Right. And I always make sure this is from Mike's perspective, not from Mel's. So I let you, with my help, determine what your criteria is, but we're going to check it against yours, because my opinion has nothing to do with this, because this is your deal, right? This is your marriage. So I want to make sure we're applying your standards to it. And also, applying your skills to it as well. So if you're lacking on a specific skill, we want to make sure maybe you're doing more secure deals, or maybe you're leveraging a teammate. And we're going to, as part of the 6 months, we're going to make sure that we can get somebody on board on your team that's going to be able to help you fill that gap. So that's part of it.
Mel, how can people get a hold of you?
I am at cardinal-creative.com. I'm also at melpalmer.me on Instagram. Got my links on my Facebook and my Instagram, and yeah.
So those of you guys who are watching live or recorded, if you guys need services related to funding opportunities, just to double check it. Actually, Mel, give me, if you could, because you say you're going to say it a whole lot better than I ever will. What would be your 2 to 3 sentence like elevator pitch again for your services?
Yeah, I help private lenders conduct due diligence so they can invest safely.
Simple. Love it. Love it. Well, Mel, thanks so much for meeting with me today. We're going to keep this at an hour so you can go spend the rest of your night having fun.
Yeah, thanks. You too, Mike. Thank you so much. And we're going to do this one more time. Yeah. What are we going to talk about?
We're going to be here next week. Yeah. So what we talked about today was the idea of how we can best protect a seller in a subject to transaction, and also how it relates to Mel's business. Secondly, what we want to talk about next week is how we can possibly work with buyers. Let's say that we're assigning this contract, for example, a subject to contract. how we can best protect a seller with an assignment involved. And I think that's really, really important because I'm seeing a lot of transactions being assigned as opposed to being taken down by the initial person talking to the seller or the agent. And there's some really unique things that we have to communicate and probably have to implement in our sales process to make sure that everyone is safe and that this doesn't go into foreclosure 6 months or 12 months after it's sold.
Totally. Awesome. Oh, looking forward to it.
Thank you, Mel. Have a good week. We'll talk to you later.
You too.
All right. Bye.
Do I do that?